Level 3, Chapter 3. Technical analysis identifies a variety of chart patterns that can be used to predict price movements. The predicted outcome of chart patterns materializes most times, in over 70% of the cases, but not all times. Watch out for similar pattern formations. Always use chart patterns in conjunction with other technical indicators. Always use technical analysis in combination with fundamental analysis. Double top. Double top is a reversal pattern. Double top is a bearish pattern that consists of two consecutive, roughly equal peaks and a moderate low in between these peaks. Graphically, the double price pattern resembles the letter M, with the right leg of the M being roughly twice as long than the left leg. The trading volume indicator can indicate whether or not the price, at its final descent, will break the support level. A mirror image of the double top is the double bottom. Head and shoulders top. Head and shoulders top is a reversal pattern. Graphically, it's a pattern that represents an extended letter W. A clearly distinct pattern is considered one whose distance from the neckline to the head equals at least a 5% increase in the price of the asset and has clearly distinguishable shoulders. The magnitude of the downward movement is expected to roughly equal the distance between the neckline and the head. Rising wedge. The rising wedge is a reversal pattern. The rising wedge forms if a price reaches a fading uptrend and enters a wedge-like shape. It predicts that the price will exit the wedge with the beginning of a downward trend. Rising wedge occurs after price consolidation. A wedge always has two slanted support and resistance level that form a triangle. The bigger the angle the support and resistance levels conclude, the higher the probability that a bearish trend will erupt in the end. The pattern's existence is confirmed when the price within the wedge tests the support and resistance level at least twice per line. Cup and handle reversal. It's a U-shaped pattern preceded by an upward trend and followed by an ephemeral downward trend, which is yet again reversed in an uptrend in the end of the pattern. The cup and handle indicator is a long-term indicator. One feature which a trader can use to distinguish the patterns is trading volume. Pattern confirmation signs. Cup rims should be roughly on the same horizontal, otherwise the pattern cannot be confirmed. The shape should look more like a U and not a V. Flag. Continuation. The flag roughly represents a tilted rectangle in which price fluctuates between the long sides without consolidating. The flagpole, or the upward trend that precedes the formation of the flag, is usually very steep. The flag is usually a short-term formation that lasts for not more than several days. Pattern confirmation signs. There's a very acute angle between the flagpole and the downside of the triangle is acute. The flag does not deviate much from the rectangular shape. Rectangle top, horizontal channel. Rectangle top, also known as a horizontal channel, is a pattern whereby the price first follows a downtrend, then enters a series of consecutive same-level tops and bottoms, and then enters a new downtrend again. The rectangle top is most efficient for short-term price predictions. Pattern confirmation signs. The rectangle top is tall. Traded volume changes randomly. The mirror image of rectangle top is rectangle bottom.